Hi everyone, today I wanted to go through a few releases from yesterday and talk a little about some findings from a few fund managers' mid-year investment outlooks. Yet again, I am not able to record this myself, so the script is taking the reins for me again. First of all, let's look at yesterday's reports. The S&P Global Manufacturing PMI for the UK beat the consensus estimate of 46.2, coming in at 46.5. However, this was still contractionary and below the previous 47.1. Some key highlights from this report were that this was the 11th consecutive decline in the manufacturing index and highlighted a slip in business confidence which hit a 6-month low. A look at the major indicators that go into this report. Output contracted for the 4th month in a row, although the rate of contraction had slowed. New order intakes experienced the most significant decline since January, and employment also decreased for the 9th consecutive month, with the rate of reduction being the sharpest since March. On the pricing front, input costs recorded the most substantial decline since February 2016. This decline was attributed to weaker demand for inputs, reduced fuel costs, decreases in commodity prices, and improved supply chains. Meanwhile, average output prices ticked lower for the first time since April 2016. In the US, we also saw their manufacturing PMI decline, in line with market forecasts, with a read of 46.3. The prior read was 48.4. A closer look at the major indicators shows that output experienced a renewed fall, as well as a sharp downturn in new orders caused by a higher interest rate environment and inflationary pressures. Employment grew further as manufacturers sought to fill long-held vacancies. In terms of cost, we saw the fastest decline in 3 years. Manufacturers are seeing weak demand as business expectations were at their lowest so far this year. We also saw a decline in the US ISM manufacturing PMI reading from 46.9 to 46. Consensus estimates were for 47, pointing to a faster rate of contraction in the manufacturing sector. This report continues to highlight a softening of optimism for the second half of the year as demand remains weak. In summary, we can see the actions taken by the Fed are starting to put the manufacturing sector under pressure, which will be something that could encourage the Fed not to raise rates further, so long as inflation remains tame. The only other report I want to talk about is construction spending. This came in higher than the consensus at an increase of 0.9%. The consensus was 0.6% and the prior was 0.4%, indicating an increase in the rate of construction spending. Private spending rose 1.1%, spending on single-family projects increased by 1.7%. Finally, multifamily fell 0.1%. With that out of the way, I just wanted to go over some research I've been doing into what some funds are saying about the current economic landscape and what their commentary is in regard to how they are managing asset allocations. I have been through a few articles from Wellington Management, Principal Asset Management, BlackRock and Baillie Gifford and found some common topics of discussion. Here are some highlights from each report. Wellington Management highlighted the unstable equity bond correlation, the return to a traditional economic cycle with distinct and possibly more frequent moves, and the need for portfolios to evolve for the longer term in response to structural economic shifts. The article notes that the negative correlation between equities and bonds, which has provided balance to many allocations, has been disrupted. With central banks facing higher inflation, bonds might struggle. They suggest that the new economic reality, where central banks can no longer focus exclusively on maintaining stable growth, will lead to a return to a traditional economic cycle. This may create challenges but also opportunities to take advantage of volatility. Principal Asset Management discussed the surprising global economic growth, high inflation, nearing end of central banks' tightening cycles, potential earnings weakness, the stability offered by high-quality fixed income, and the importance of diversification through alternatives. The article notes that while US growth has remained strong, leading indicators continue to signal a potential recession. Tighter lending standards due to the recent banking crisis increase the risk of a hard landing. The article suggests that part of the inflation basket will soften rapidly in response to normalizing supply chains and energy prices, but other key segments still require considerable weakening in labour markets if there is any hope of approaching the target. They also mention that central bank policy rates will likely peak soon, but rate cuts are unlikely unless there is a severe and dangerous spike in financial system stress. 2023 is likely to be dominated by earnings and economic growth scares, which threatens to take equities lower in their view. They suggest that central banks are likely nearing the completion of their tightening cycle, which is something I agree with. BlackRock discussed the new economic regime providing different investment opportunities, the need for granular approach within asset classes, and the impact of mega forces on investment opportunities. They also discussed their broad asset allocations and their preference for emerging markets and income. The report suggests that the new, more volatile economic regime provides different yet abundant investment opportunities. They believe supply constraints will keep inflation sticky and compel central banks to keep policy tight. Baillie Gifford discussed their strategic asset allocation of 75% equities, 20% bonds, and 5% cash, their current allocations, the decision-making process for asset allocation, and the limits for allocation. The overweight in equities reflects the enthusiasm coming through from their UK emerging markets and developed Asian managers. A shared point that I found interesting was the mention of equities in driving long-term growth, despite potential short-term volatility. Inflation and the actions of central banks are recurring topics, with the articles noting the impact of these factors on asset allocation decisions. The potential for higher inflation and tighter monetary policy is seen as a risk that could disrupt the traditional negative correlation between equities and bonds. Another common trend is the focus on a more granular approach to asset allocation. This involves looking beyond broad asset classes and considering factors such as regional, sectoral, and industry preferences, as well as the impact of structural forces like technological innovation. One trend we have seen this earnings season was the higher earnings outlooks from software companies. AI is also driving a surge of investment, and despite the CHIPS Act, chips makers seem to be performing well. Some sectors of finance have also been high performers so far this year. These articles highlighted the need for flexibility and patience while the markets go through continued uncertainty, which inevitably puts us in a volatile market. The need for a granular approach is also something I agree with. Essentially, it is a stock picker's market and the focus on particular sectors could outperform. I agree that the Fed is likely near or at the end of their rate hike cycle, and fears over economic slowdown could lead to a period of time where rates remain flat, which would introduce some optimism into equities that aren't seeing a decline in earnings, which is something I have been trying to position the portfolio towards and continue to make adjustments. Anyway, I need to leave it there today. Hopefully I can go into more detail in a future update. So thank you for listening, and see you again in the next update.